Have you ever stopped to ponder the origins of the money you use every day? In the beginning, there was barter. This system of trade, where goods and services were exchanged directly for other goods and services, was the first step in the journey towards the concept of money as we know it today. Picture this: you're a farmer with an excess of wheat, but you need a new plow. You'd have to find someone who has a plow but also needs wheat. Sounds simple enough, right? But, as societies grew larger and more complex, so did the limitations of the barter system. The first money was not coins or paper, but commodities that were widely recognized for their inherent value. Livestock, grains, even shells and stones were used as a form of currency. These commodities had a value that was generally accepted, and therefore could be traded for other goods and services. But commodities had their own set of problems. Livestock, for instance, was not a very portable or divisible form of currency. Imagine trying to buy a loaf of bread with a cow, and grains, while more portable and divisible, could rot or be destroyed by pests. The need for a more practical form of money led to the use of precious metals. Gold, silver, and bronze were durable, divisible, and had a value that was widely accepted. These metals were shaped into coins, marking the birth of money as we would recognize it. The first minted coins appeared in Lydia, a kingdom in modern-day Turkey, around 600 BC. These coins were made from a naturally occurring mixture of gold and silver called electrum. They were stamped with intricate designs to denote their value and authenticity. Money, as we see, began as a simple solution to the limitations of barter. But, as societies grew, so did the complexities of this system. And with that, began the evolution of money, adapting and transforming with the needs and technologies of the times. Stay tuned as we delve deeper into the fascinating journey of money in our next segment. Do you know where and when paper money first appeared? Well, let's turn back the pages of history and journey to the Far East, specifically to China, during the Tang dynasty, which spanned from 618 to 907 AD. It was in this era and place that paper money made its grand debut. The Chinese, always ahead of their time, were the first to use paper money. But why paper, you might ask? The answer is simple: convenience and portability. Imagine trying to lug around hefty coins or even barter goods for every transaction. It would be impractical and downright exhausting. Paper money, on the other hand, was lighter, easier to carry, and allowed for more complex and large-scale transactions. A merchant could carry a single piece of paper representing a large sum, rather than a heavy bag of coins. It was a revolutionary concept that changed the way societies operated, but as with any innovation, it wasn't without its problems. The most significant of these was forgery. With coins, particularly those made from precious metals, counterfeiting was difficult. The resources needed to forge coins were hard to come by, and the process was labor-intensive. Paper money, however, was a different story. While the Chinese government tried to prevent counterfeiting by implementing harsh penalties for forgers, the problem persisted. It was easier to replicate a piece of paper than to forge a coin, and so the issue of counterfeit money became a widespread concern. Despite these challenges, the invention of paper money was a monumental stride in the evolution of commerce and economic systems. It facilitated trade, enhanced economic growth, and paved the way for the financial systems we know today. The advent of paper money was a huge leap forward, but it brought with it its own unique set of challenges. A statement as true today as it was over 1,000 years ago. But these challenges, as we will see, were not insurmountable. They were merely stepping stones to the future of money. And that future, as we'll discover in the next segment, was golden. Ever wonder why gold has been so valuable throughout history? Let's delve into the concept of the gold standard, a monetary system that directly linked the value of a country's currency to gold. This system was widely implemented in the 19th century, marking a significant shift in the history of money. So, what was the purpose of the gold standard? The answer lies in its aim to stabilize economies. You see, under this system, the government guaranteed that it would redeem any amount of paper money for its value in gold. This promise reassured people that their money was worth something tangible, something real. Gold. Picture this: if you lived in the gold standard era, you could walk into a bank, hand over $10 of paper money, and walk out with $10 worth of gold. The idea was that there was a fixed amount of money in the economy tied to the finite amount of gold the country possessed. This limited the amount of money that could be printed, preventing the government from inflating the economy by just printing more money. Gold was chosen for this system because it has some unique qualities. For centuries, it has been treasured as a precious metal, renowned for its rarity, beauty, and indestructibility. It doesn't tarnish or corrode, making it a perfect metaphor for a stable, reliable currency. However, the gold standard wasn't without its challenges. The reliance on gold limited the flexibility of economies to respond to changes, such as economic downturns. And as we'll see in our next scene, it was eventually abandoned in favor of a different system. The gold standard was a significant pivot point in the history of money, tying the value of currency to something tangible and limited. This system represented a profound shift in our understanding and use of money, one that would have lasting effects on global economies and financial systems. What would you say if I told you that the money in your wallet is just a piece of paper? Intriguing, isn't it? But that's the reality of fiat money, the form of currency we use today. Let's rewind a bit to the era of the gold standard. Under this system, the value of money was directly linked to gold. You could exchange your paper money for a specific amount of gold. This gave people faith in the value of their money because it was backed by something tangible. But this system had its challenges. It limited the amount of money that could be in circulation to the amount of gold a country had. And let's face it, there's only so much gold on Earth. So, in the 20th century, many countries started to move away from the gold standard. The big shift happened in the 1970s when the United States, which held the world's main reserve currency, completely abandoned the gold standard. This marked the birth of the fiat money era. But what exactly is fiat money? The term fiat comes from the Latin fieri, meaning let it be done. Fiat money is currency that a government declares to be legal tender, but it's not backed by a physical commodity. Instead, the value of fiat money is derived from the relationship between supply and demand and the stability of the issuing government, rather than the worth of a commodity backing it. So, how does fiat money hold any value? It's all about trust. We trust that the pieces of paper and coins we exchange for goods and services hold a certain value. We trust that the government issuing this money won't suddenly collapse, rendering our cash worthless. And most importantly, the person or business we're giving this money to trusts its value too. In essence, the value of money became a matter of trust, a belief in the government that issues it. Fiat money then is a fascinating concept that shows us that the value of money isn't in the paper or coin itself, but in our collective belief in its worth. Could you imagine a world where physical money doesn't exist? This question is less hypothetical than you might think. We have entered the age of digital currency, a time where money is not bound by physical form or government control. The rise of digital currency kicked into high gear with the introduction of Bitcoin in 2009. This digital money, also known as cryptocurrency, operates independently of a central bank. It's a peer-to-peer system with transactions taking place directly between users. But how does it work, you ask? Well, digital currencies use cryptography, a method of protecting information through codes, to secure transactions and control the creation of new units. Cryptocurrencies are essentially digital assets that rely on a network of computers to validate and record transactions on a public ledger known as a blockchain. Blockchain technology is the backbone of digital currency. It's a decentralized ledger of all transactions across a peer-to-peer network. This technology allows participants to confirm transactions without the need for a central clearing authority like a bank. Blockchain's influence extends beyond just digital currency, with potential applications in various fields like supply chain management, healthcare, and even voting systems. Now, digital currency might sound like the perfect solution with its promises of decentralization, anonymity, and security. But it's not without its drawbacks. The price of cryptocurrencies can be extremely volatile, and there's also the risk of digital theft. However, with proper security measures, these risks can be mitigated. Moreover, the adoption of digital currency is still a contentious issue. While some countries have embraced it, others have outright banned it. The future of digital currency is still uncertain, but its potential to disrupt traditional financial systems is undeniable. As we stand on the brink of a potential revolution in how we use and understand money, one can only wonder, what's next in the evolution of currency?